Hello everyone. As you can see, I've gotten visibly tanned and I've changed locations again. Let me chat with you all for a bit. Even though the setting where I talk about finance is really informal, I'm just here in an old t-shirt on vacation, but the things I discuss are still quite serious. So without further ado, let's get straight to the point. All finance originates from gambling. So all finance is essentially a form of gambling. It's all about the word game or setup. Right now, because the Chinese language is so innovative, people in China no longer like to use old terms, so they don't use the word game anymore. Currently, at this very moment, in the financial industry, the term they use now is panzi, which literally means plate. They refer to every financial case or deal as a panzi. In the past, we used to call it hosting a game, which were old terms. Panzi, or game, they all mean the same thing. A gambling setup, a card table, it's all the same. So, this setup has undergone a major evolution compared to the old gambling setups. What kind of major evolution? Think about it. Let's not use those formal bookish terms to understand this. The most traditional gambling setups are nothing more than mahjong or poker. Those are the classic gambling games, or betting on big or small, high or low. But what is the problem with traditional gambling setups? The stakes can't get very high in these traditional gambling setups because you know exactly who your opponents are. Whoever wins your money, you know who to blame. That's the key issue. At a mahjong table with 4 people, one person wins and the other 3 lose, and all 3 resent the one winner. Or if one person loses and the other 3 win, then that one person resents the other 3. Who wins and who loses, it's all too straightforward. First, what does this reflect? It reflects that the number of participants is limited by physical constraints. There are only 4 seats at the table. It's impossible for 5 people to play mahjong. You just can't do it. So in this case, whether you're playing this game or that game, at most there can only be a few people involved. That's the first point. The second limitation is how much money you can bet. The difference can't be too great. For example, let's say I'm a billionaire and you're just a hard worker. It's very hard for us to gamble together at the same table because for me, I might want to bet $100 on a single round, but for you, how much would you want to bet? $1 per round. So there's just no way to play together. That's the second point. On a traditional gambling table, there's another limitation. The third limitation is that there's a gap in skill. If you're quick-witted and experienced playing every day, then you'll win. The probability of winning becomes much higher because there's skill involved. It's not purely about luck, especially with games like mahjong, blackjack, or Texas Hold'em. There's a strong technical aspect to them. So this also limits how people play at the table and how much they participate. If your skill level is too low, others won't want to play with you. So for all these reasons, traditional gambling games are actually very simple. Their harmfulness is also very straightforward. So whenever the topic comes up, respectable nations and people, regardless of East or West, ancient or modern, are generally unwilling to encourage mainstream society to gamble. Because it's too simple and too harmful, it's a zero-sum game with a very strong zero-sum nature. So how did it make the leap into the financial industry? How did it go from being a zero-sum game to entering the financial industry, which is not a zero-sum game? This is where a huge leap occurred. This leap was the emergence of the house. The house is the rule maker and also the enforcer of those rules. That's what it is. In the past, at the gambling table, where you and I bet against each other, there was no house. The house, by setting the odds, is able to infinitely expand the range of participants in the financial market and take all comers, big or small. Whether it's $1 or $10,000, you can play with any amount under these game rules. The ultimate result of this evolution is what we see today. Electronic currencies, Bitcoin, blockchain, stocks, the foreign exchange market, futures markets, and commodities. All of them have entered this kind of state. What kind of state is this? Let me give you an example of an intermediate state, which will make it much easier to understand. It's betting on football matches. This intermediate state is very easy to grasp. For example, in Serie A, two teams are playing. One is a bit stronger and the other is a bit weaker. So what are the odds for these two teams? The person who sets the rules for this game is called the bookmaker. It's not like just anyone can set the odds. If everyone could, how would the game even work? So it's the bookmaker who does it. And bookmakers have professionals who do precise calculations. The odds are set and then announced. Once they're announced, everyone has to play by these rules, including the bookmaker. If the bookmaker wants to bet, they also have to follow these rules. What happens if everyone bets correctly? Then the bookmaker has to pay out. The bookmaker is responsible for fulfilling the payouts. This is essentially the prototype of the modern financial market. The financial market, including the stock market, actually evolved from this kind of betting market, taking it a step further. Betting on football has a lot of limitations. First, you have to understand football. Second, you need to have football matches. As more and more people get involved in this kind of game, and as more and more normal people turn into, well, abnormal people, more and more lunatics, because as Soros said, finance is a game for madmen. Wall Street was founded by a bunch of madmen. And as there are more and more madmen all over the world, as it becomes more and more widespread, everyone needs to keep betting on games, and the matches can't stop. So what do? That's where stocks come in. As long as the stock exchange is open, you can play. Later on, it even got to the point where, for example, global precious metals trading operates 24 hours a day nonstop. After the trading session in London ends, the next round starts in Hong Kong, and then after that, it moves to Chicago and the US. The trading rolls on globally 24 hours a day, so you can place your bets at any time. This is how the prototype of modern finance emerged. So after modern finance appeared, is the money that the house wins actually the money lost by ordinary people? Think about it carefully. This brings us to a fundamental concept in finance. Whose money is the house really winning? How is this different from playing mahjong or poker? When you're playing mahjong, it's very clear to you that the money you win is the money lost by the old lady sitting across from you, right? But in finance, the house doesn't know whose money is winning. The house can't clearly identify whose money it will win or who will win its money. This is one of the great innovations of modern finance, a truly remarkable breakthrough. To me, Lao Wang, working in finance for decades, I've asked myself, if I could take a time machine back hundreds of years to the sycamore tree on Wall Street, what would I say to the financial founders and pioneers of that era? I would tell them, your greatest invention is when you win a bet, the person who lost doesn't know who to seek revenge on. This is extremely important because it completely eliminates everyone's sense of guilt. Instead, it is replaced by the winner's sense of accomplishment, a very legitimate, professional sense of achievement in one's career, rather than the feeling you get from making money through shady means, that sense of lucky survival. So this evolutionary significance cannot be overstated. It's as important as humanity's invention of fire. So how does this work in practice? How does the house win this money? It's very simple. This involves a mathematical principle called the Gaussian curve or the bell curve. It looks like an upside-down bell placed on the ground. That kind of curve, the bell curve, what does its principle mean? Its principle is that 80% of people make random choices, and those random choices will definitely fall within 20% of the range. This is the key to how the house wins in all financial markets. The house doesn't know who will fall within that 80%. The house doesn't know who will fall outside the 20%. But as long as the house bets according to this rule, it will always work. That is, if you let everyone randomly report something, and when the number of people is large enough and their answers are varied enough, you'll find that 80% of people's responses fall within a certain range. Let me give you an example to help you understand this better. Let's say, for example, many of Lao Wang fans like to hear my dirty joke. So let's ask, How long is Lao Wang's little brother? Or how big is Lao Wang's cock when he's hard? Regardless of gender, as long as you're an adult, give me a number. Don't discuss with each other, and don't try to measure it. That would be illegal. Just secretly write down a number. You'll find that the numbers written by 80% of people fall within a very narrow range. No one would say that Lao Wang's cock is 1 meter long. No, barely anyone. And no one would say Lao Wang's cock is only 1 centimeter long. Of course, there might be some people who claim Lao Wang is extremely well endowed, he's the nothing god, and that he has a 300 meter or 300 foot long huge cock. Well, that's also possible, but it's extremely rare. Maybe out of 50,000 fans, only one person would write 300 feet. Most people out of 50,000 fans, about 40,000 would write a number between 10 and 18 centimeters, because that's a rational human judgment. There are even more examples that aren't so dirty. Like, if you ask everyone to guess the height of the tallest human, most people, almost everyone, would write a number somewhere between 2 and 3 meters. No one would write 100 meters, and even less would write 1 meter, right? What does that mean? This is what happens when each person independently makes a random, rational judgment. In fact, they will unconsciously follow the law of large numbers. The law of large numbers is the foundation of the aesthetics of the universe. It's not just humans, not just you and me making judgments. Nature works the same way. For example, when we look outside at a tree, in autumn the leaves will fall. If you don't interfere and just let them follow the laws of nature, you'll notice that after all the leaves have fallen, 80% of them will be within a circle. Imagine drawing a circle around the center of the tree. 80% of the leaves will fall within the circle. They won't get too far, while the remaining 20% can get very, very far away. This is also true in nature. It follows the law of large numbers and the Gaussian curve. So when you are the house, when you are designing your money, you don't need to worry about exactly whose money you win. You just need to ensure 2 principles. First, there must be enough participants in the game. You can't just have one person. If there's only one person playing with you, then it's meaningless. For example, you need at least 500 or 1,000 people. Right now, I has 50,000 followers, which is more than enough. 50,000 followers can support a very good market with liquidity and clear mathematical principles. That's the first point. Second, you can't let them unite and discuss things with each other. In other words, the house must keep the participants isolated from each other. You might say, but Lao Wang, isn't that wrong? Aren't there plenty of forums and communities in today's financial markets? Well, that's where you're mistaken. Many of the people in those forums are actually shills planted by the house. The real secrets and genuine information held by the house will absolutely never be leaked. If that information were to get out and you found out, then the house would truly lose, and the law of large numbers would no longer work in the house's favor. So as long as the house ensures, first, the absolute security of information, and second, that there are enough participants, then with these 2 conditions, their financial market can continue to operate. So by the time I've explained this much, you should understand why things like all kinds of tokens or BTC cloud mining can make money. The first reason is that they have enough participants. For example, they've sold 50,000 boxes. Then it can absolutely harvest retail investors on a daily basis. Second, it needs to keep things secret. What kind of secrecy? It doesn't really care if you discuss things among yourselves or form groups. In fact, it even encourages you to form groups, because that's basically marketing and sales for them. What they're afraid of is not you discussing among yourselves, but that you might talk about the plan you saw on the main server for manipulating the curve. That's the real information. As for the rest, everyone is just guessing. Will it go up or down tomorrow? Will it rise or fall tomorrow? That's not called information, because it's from the main server. It's a K-line chart that's been manipulated by people, so that's the real secret. If such software is mature enough, it would generate random numbers randomly. It's an automated trading system run by computers. An AI automated trading system is essentially controlled by people. That's why not even the programmers can know which way the curve will move in the next second. To some extent, the curve really is a random one, and this is based on the law of large numbers. It constantly monitors and reads all the buy and sell orders from every player. Someone sells, someone buys, someone goes short, someone goes long, and then the computer automatically decides whether the price will go up or down. As long as it decides to go up or down each time in the opposite direction of the majority, that's enough. It just needs to capture the majority of people. This is the core secret of market makers in the financial markets, in all financial markets, whether it's manipulating a single stock or the 5 major bullion banks manipulating a precious metal like gold, or in the forex market manipulating a certain currency or manipulating a particular cryptocurrency in the blockchain. Every expert market maker must follow this principle. So, what ultimately determines the outcome? If there are conflicts between market makers, or if there's more than one market maker in the market, what is the final deciding factor? In the end, it's determined by who has the deeper pockets, who has more money. I have a senior, a very impressive person, who later became the governor of the People's Bank of China, this old leader back in the day. He studied on Wall Street in the US, read a lot of books, and became very skilled on Wall Street. A top guy at the Federal Reserve used to teach grad students at an American university. My senior was one of his students. So he truly understood the core essence of how Wall Street operates. And the core essence isn't complicated. There aren't all those messy formulas. It's about humanity, philosophy, and even a kind of divinity. So when Soros attacked the Hong Kong dollar, this person was assigned. He carried a laptop and a small blackboard into Zhongnan High to give lectures to Zhu Rongji and Jiang Zemin. Zhu Rongji and Jiang Zemin didn't really understand finance. Zhu Rongji said he did, but actually no. And it was harder to lecture Jiang Zemin. After he explained clearly to Zhu Rongji asked him to explain it to Jiang Zemin. Jiang Zemin only gave him half an hour. Jiang Zemin was actually quite formidable because he thought, if you can't make me understand in half an hour, I'm not an idiot. I'm no child. If everything's connected and your explanation just gets more complicated, then either you're no expert or you lack true mastery. Connect the dots. Otherwise, you're just fooling me. It took him half an hour to explain it to Jiang. After listening to this, Jiang simply asked, "Do we have more money? Us or Soros?" He said, "With our money plus the Hong Kong government's funds, we have much more than Soros. That means we can win this round. We can win, so let's do it." Soros was defeated in Hong Kong and almost went bankrupt, all because this person gave Jiang that report. I've written about this detailed process on my Twitter. This was something Soros hadn't anticipated at the time, because the 300 to 400 billion in foreign exchange reserves held by the Central People's Government of China and the 400 billion in reserves held by the Hong Kong government were supposed to be separate and not interfere with each other. Historically, they had never been combined because Hong Kong used to be essentially an independent economic entity, almost like an independent country. Economically, it was independent, and it was never considered together with mainland China. So when Soros was attacking at the time, he didn't expect that during the defense of the Hong Kong dollar's peg to the US dollar, mainland China would step in and use its foreign exchange reserves. That was like suddenly adding leverage, and Soros was defeated in a landslide. All of Soros's money was won by the Hong Kong government. That time, the Hong Kong government made over 10 billion US dollars in cash. Over 10 billion. Soros suffered a serious blow. What I'm trying to tell everyone is that in finance, there really isn't anything new, no matter how sophisticated it sounds. Many of my viewers ask, is this platform real or fake? Is that broker real or fake? It's actually very simple. Can you withdraw your money? Can you cash out your earnings? Bank to securities transfers, that's the first criterion to judge by. But even that can't guarantee it's real, because when a scam gets big enough, they'll also maintain a certain level of liquidity. The whole point is to pull in more people. This doesn't guarantee it's real, but it filters out most of the fake. And there's one more test, the kind that uses real money, to see if it's legit. For example, if you buy a US stock, will that company notify you to attend the shareholders meeting? That's the real test. if you bought a lot of NVIDIA stock, a lot of Lockheed Martin stock, or a lot of Microsoft stock. But if Microsoft has never sent you an invitation to the shareholders meeting, nor any documents related to the meeting, and you never received the annual report as a shareholder, then it's fake. No matter if it's called Singapore something securities, or Hong Kong something securities, or whatever other name, as long as you haven't received a shareholders meeting notice, it's fake. Someone might ask, Lao Wang, is there a minimum stockholding requirement to receive a shareholders meeting notice? Yes, there is. But you can find that information very clearly in the company's basic materials. The threshold isn't that high. It's not as difficult as you might imagine, like having to buy 1 million or 10 million shares. With just tens of thousands of US dollars, you can be notified. Basically, for most of the main board-listed companies in the US, or companies listed on the New York Stock Exchange, if you hold just tens of thousands of dollars worth of shares, you'll be notified to attend the shareholders meeting. There will be PDF files and emails sent to you. There are also paper documents mailed to the address you provided when you opened your account. The shareholder meeting documents will all be sent to you if you've never received them before. You'd better consider switching to another broker. It's very likely that what you bought is a virtual trading platform, because virtual platforms are everywhere. The virtual trading platform itself is an ecosystem, and as long as the stock market doesn't experience major fluctuations, these virtual platforms, especially the large and powerful ones, are possible, but very unlikely. Just pack up and disappear, because the operators have no reason to kill the goose that lays the golden eggs. However, once a sudden financial event occurs, since they don't have any guarantees or security and there's no regulation, they might just pack up and leave, leading to scandals. There's nothing you can do about it. For them, maybe it's just losing a quarter's profit before they run away. But for you, it could mean losing everything. Your whole family's fortune could be wiped out.